Even if we both end up with the same average return over time, I could run out of money years earlier just because of when the losses hit. That sequence of return risk. And right now, with market volatility rising, inflation heating up again, and recession risk mounting, retirees are especially vulnerable to this. Hi, I'm Chris Hensley with Houston First Financial Group. Welcome back to Retirement in a Recession. This is episode 2 in our 8-part series focused on helping pre retirees and retirees navigate today's uncertain economy with confidence. In episode 1, we talked about where we are in the economic cycle. We're likely at the beginning of a recession, even if the headlines haven't caught up yet. But today, I want to show you something that may be even more dangerous than a market downturn. It's called sequence of return risk. And it's a silent threat that could quietly ruin your retirement, even if the average market returns end up looking just fine. So, what is it? Sequence of return risk is the danger of experiencing poor investment returns early in retirement, right when you start taking withdrawals from your portfolio. It's not about how much the market returns over 30 years. It's about when those returns happen and how they line up with the timing of your income needs. Let me show you what I mean here. Let's say that you and I both retire with the same portfolio. We both withdraw the same amount every year. But in my case, the market is down for the first 3 years of retirement. In your case, the market's up for the first three, then falls later on. Even if we both end up with the same average return over time, I could run out of money years earlier just because of when the losses hit. That sequence of return risk. And right now, with market volatility rising, inflation heating up again, and recession risk mounting, retirees are especially vulnerable to this, right? And, this is a great place to share this with you. This is the whole reason I'm making these videos. Back in 2008, I had a client who just retired. They had great savings, smart investor, but they started drawing income as the market collapsed. Now, these are real life situations. This guy had to go back to work earlier and then go and retire later on, right? Because the math just didn't work out. That one sequence, a few bad years, meant that they never fully recovered. We built better strategies after that, and I never forgot that lesson, right? These are things that I share with you because they are, some of the most difficult lessons to learn in life, right? Here's the real problem. Most financial plans are built around averages, average returns, average lifespans, average inflation. But retirees don't live in averages, they live in year by year realities. So when the market drops and you're pulling income, you're locking in losses. That leaves fewer dollars in your portfolio to recover when the market does bounce back. And that more often that happens early on in retirement, right? The harder that it becomes to make up for it later. So what can you do? This is where our active management philosophy really shines. We work with clients to create buffer assets and safe income buckets. We reduce equity exposure when conditions are hostile, and we adjust your drawdown strategy to minimize withdrawals in down markets and shift back into growth mode when conditions improve. We're not trying to time the market. We're simply recognizing that when you're in retirement, the stakes are higher and your strategy needs to match the environment that you're in. In the next episode, we're going to go even deeper on this concept and tackle a common myth. Buy and hold always works. We're going to talk about when buy and hold is brilliant and when it's actually reckless, especially for retirees. So make sure that you're subscribed so you don't miss it. If anything I said today struck a chord with you, if you're realizing your retirement strategy might not be built for this environment, go to HoustonFirstFinancialGroup.com and book a retirement risk review. I'm Chris Hensley, and I'll see you in the next episode, The Retirement Myth of Buy and Hold, when it works and when it doesn't. See you then.